Your roadmap to the latest in auto. Welcome to Highway Herald. Today, we're shifting gears from engines to something just as weighty: gold. Germany and Italy are demanding nearly 2,000 tons of gold, over $200 billion, be returned from the New York Federal Reserve. Why now? Rising tariff tensions and political distrust are straining transatlantic ties. This isn't just about bullion. It's a bold move with major implications for U.S. financial dominance, global reserves, and international trust. Buckle up. This golden power play could redefine the rules of the global economy. Vaults of the past, questions of the future. Since World War II, Germany and Italy have kept large portions of their gold, 5,804 tons combined, secured in the vaults of the New York Federal Reserve. This Cold War-era strategy was built on transatlantic trust and the need for security. But that trust is now eroding. Germany, with 3,352 tons, 37% still in New York, and Italy, with 2,452 tons, 43% stored offshore, are rethinking this decades-old setup. The trigger? Donald Trump's return to the White House. Concerns are mounting over potential interference in the Federal Reserve, with Germany's Taxpayers' Federation warning that control over the Fed could mean indirect control over foreign-held gold. What was once the domain of fringe voices, AfD figures, and gold bugs, is now mainstream debate, echoed by outlets like ZDF and ARD. Even CDU leader Markus Ferber is advocating for diversified gold storage. Meanwhile, Bundesbank officials insist that regular audits, covering about 13% of New York holdings, show the reserves are secure. Still, with 95% of global central banks expecting gold reserves to rise and 59% now keeping it at home, trust in offshore storage is rapidly fading. But the gold debate doesn't end in the vault. It's now burning through parliaments and headlines in Berlin and Rome. Sovereignty sparks political showdown. This debate goes far beyond bullion. It's about sovereignty, political leverage, and national identity. In Germany, what was once dismissed as a fringe nationalist cause is now front and center. Figures like Alice Weidel and Peter Beringer of AfD have long linked gold to sovereignty, but even left-leaning voices like Fabio De Masi are now weighing in. In a Financial Times op-ed, De Masi argued that in times of geopolitical volatility, the physical location of national gold reserves matters deeply. Italy's conversation mirrors that shift. While Prime Minister Giorgia Meloni once pledged to repatriate Italy's gold in 2019, her current administration proceeds cautiously. Still, analysts like Enrico Grazzini are sounding alarms, warning that entrusting nearly half of Italy's reserves to a Trump-led US is risky. Germany's CDU isn't standing by. Markus Ferber is now using the gold issue as a strategic bargaining chip in trade talks, especially regarding tariffs. With public pressure rising, this is no longer a financial technicality. It's a loaded symbol of national autonomy. And when talk turns into action, that gold has to move, raising a whole new set of challenges. Before we delve deeper, if you're finding this golden saga as gripping as we are, make sure to subscribe to Highway Herald. Your support fuels more deep dives into the crossroads of cars, currency, and global power. Now, on to the heavy lifting. How to move a mountain. Literally. Repatriating 1,900 tons of gold isn't just symbolic. It's a complex logistical feat. Germany has done it before. Between 2013 and 2017, Berlin successfully brought back 674 tons from New York and Paris, using NATO-coordinated night flights and tight military security. The operation cost 7 million euros and proved that moving mountains of gold can be done quietly and safely. If Germany and Italy execute a similar plan today, they'd be shifting $245 billion in bullion, flying it out of the New York Fed in 50-ton weekly loads using C-17s or IL-76s. The playbook? Alternate vault deliveries between Frankfurt and Rome under NATO protection, with secure corridors and military escorts. But this time, politics are the real hurdle. While the Bundesbank still calls the U.S. vault trustworthy, it's signaling readiness to move, if Berlin approves. Italy also needs cabinet clearance on cost and diplomacy, and the real shockwave? A joint repatriation might rattle Washington, signaling a deeper mistrust in U.S. financial leadership under Trump's renewed influence. And if those shipments begin, the financial world could feel the turbulence fast. especially on Main Street, not just Wall Street. When gold moves, rates react, from repo shocks to rising car loans. The impact of Germany and Italy pulling over $200 billion in gold from U.S. vaults isn't just symbolic, it's financial whiplash with real consequences. Picture this: the Federal Reserve's reverse repo balance spikes by $20 billion in just 1 week. That kind of liquidity shock can shake the foundations of lending markets. If both countries sell off $18 billion in short-term treasuries to finance the transfer, yields could rise by 15 basis points. That may sound minor, but for everyday Americans, it's tangible. Mortgage rates on a $350,000 loan could climb enough to add $30 a month, or $360 annually. And then there's the auto sector. Higher loan rates combined with increased labor costs could drive down car sales by 500,000 units a year, putting 10,000 jobs at risk across the industry. Municipal bond yields could also jump 30 basis points, freezing key infrastructure projects. While Washington might respond with swap lines or covered bond measures, these are just stopgaps, ones that threaten the credibility of the dollar's dominance itself. But behind all these rate hikes and repo ripples lies a bigger story, one that could reshape the world's reserve system entirely. Shifting gears, the global reserve race away from the dollar. This isn't just about moving gold, it's a major shakeup in global reserves. By the end of 2024, gold made up over 20% of central bank holdings, nearly double the share from 2000. If Germany, Italy, and others continue repatriating, that could rise to 25% by 2028. The fallout? Less demand for U.S. treasuries, higher yields, and rising borrowing costs. Economists warn that the U.S. neutral interest rate could climb to 3.5%, reducing the Fed's ability to fight inflation. Cheap credit? A thing of the past. Car loans, home mortgages, and even EV incentives will feel the pinch. Worse, a feedback loop looms. Gold repatriation erodes dollar trust, reduces treasury demand, and further boosts reserve diversification. With 43% of central banks planning to grow gold reserves and 95% expecting demand to rise, the trend is clear. We may be entering an era where the dollar no longer leads by default, and for U.S. consumers and industries, that shift will hit where it hurts most: the wallet. Closing thoughts: repatriation, rates, and the road ahead. Germany and Italy's gold repatriation move isn't a footnote, it's a bright warning light on the dashboard of the global financial system. On the surface, it's about bullion. But underneath, it's about sovereignty, financial independence, and eroding trust in U.S. institutions amid trade tensions and political unpredictability. The short-term effects are already looming: liquidity strains, rising borrowing costs, and pressure on core U.S. sectors like housing, autos, and infrastructure. The bigger question is whether the dollar will remain the world's top reserve currency, or if the global tide is turning. What's your take? Is this just symbolic posturing, or a genuine challenge to U.S. economic dominance? How might higher rates impact your next car or home purchase? Could gold become the new foundation of global trust? Let us know in the comments below. And don't forget to subscribe for more deep dives from Highway Herald. Thanks for watching, and see you next time. You can now check out any of the videos on the screen. There's more exciting and informative content waiting for you.